BYND is down fractionally. Okay, this is Monday, the 12th of January 2026. We'll just have a look at what's going on its January 16 and February 20 option series. Let's see what we have here. You can see what we have. These are the opening interests up to $2 for these January 16 call series. These will expire this Friday, the 16th, and then these will expire on the 20th of February. So here we're going to consider what's going on and why the stock isn't really moving. It's not really it's hardly retested. Okay, well, it was at $1 as of Wednesday the 7th, but I doubt if it closed at that price that day. It didn't close there. So let's find out what's going on. So volume is usually around 92 million shares over the last 50 trading sessions. I think much of what is behind that is what market makers are equally doing. They have to do their job, so we're not criticizing them here. So short interest is around 28%, meaningful but not yet panic zone. Positions, option positioning, heavy call open interest stacked above spots, especially $1 and $1.50. So this is a classic pin and positioning plus optionality compression setup. What market makers care right now? Market makers don't care about the story. They care about net delta exposure, gamma risk, pin risk around $1, not getting run over if price escapes. Right now, BYND is sitting in the most dangerous place possible for them, just above the highest delta concentration, $1 strike. Okay, so January 16 calls near term gamma battlefield. $1 strike for January 16 open interest. You can see what's going on there. This is it's we're talking about 35 to 40 million shares of synthetic delta exposure. This is the critical level. Market maker behavior. As long as price stays below $1, market makers are lightly long stock to hedge calls to hedge call deltas, and they're actively selling reps near $1 and buying dips near 0.9 to 0.95. This creates the tight range, heavy volume, no movement you're seeing. They are pinning the stock. So the $1.50 to $2 calls, sorry, $1.50 and $2 calls, much lower deltas. Okay, they are currently cheap convexity bets. Market makers are not heavily hedged here yet. These strikes only matter if $1 breaks and holds. February 20th calls, the real threat layer. This is where it gets interesting. Okay, $1 strike for February 20 call series. Open interests, we have them there. Delta, that's that. These are already in the money adjacent, meaning market makers are already long stock to hedge. Any move above $1 increases delta fast. So $1.50 slash $2 February calls. Okay, these are the deltas option clustered and meaningful. So you can find a link to this in the description box below, and you can always digest and read yourself. So let's see now. Let's get down to the summary. Let's see here. Okay, they are watching sustained trade above $1.50, preparing contingency hedges. Okay, they are watching sustained trade above $1 2 cents and $1.05. Okay, call buying accelerating at $1 and $1.50. Volume staying elevated after if they break. If that happens, they will flip from sellers to force buyers. Hedging will become directional. Gamma turns against them. That's when moves get violent. So yeah, you can always pause and have a read, or you can look into the description box, and you see the link to this. So currently, this to summarize everything, market makers are currently pinning BYND just under $1, recycling massive liquidity for spread capture, defending against near-term gamma risk, watching for a decisive break to switch posture. So if $1 fails, range continues, options decay wins. If $1 holds, market makers flip to buyers. Okay, gamma accelerates, shorts feel the heat, volatility expands fast. This is exactly the kind of setup where nothing happens until everything happens. Okay, so see what you make of what's going on, and thank you very much for watching this video.